In this session, we continue our consideration of forward and futures contracting to take up the topic of valuation. The one thing to note is that when we're talking about valuation for forward and futures contracts, the notion of valuation just means something a little bit different than it has when we looked at, say, valuing a stock or a bond. Because primarily what we've seen is that at the origination of a contract, the value of the forward or the futures contract is always zero. And so really what valuation is going to mean, as we'll see, is what is the proper level of the futures contract price so that the value of the contract is equal to zero initially. So that's really what we're going to be focusing on is what exactly is that futures contract price supposed to be? So again, just as a way of recapping a little bit, forwards and futures are essentially the same arrangement. The difference is really whether you trade directly with another counterparty like a bank, like J.P. Morgan, or you go through an exchange. And there'll always be collateral involved in a futures contract. And there won't always be, but often is collateral in a forward contract. That's a term that the two parties can agree to. The point, though, is that in either case, no money changes hands between the long position and the short position. So, in different words, what that means is that the value of the contract at origination is zero. So, then the whole idea is what futures contract price for that completing the deal at the later date would the long and the short position have to agree to so that I wouldn't have to pay the short position and the short position wouldn't have to pay me, assuming I'm in the long position at this point. So that's what we mean by valuation. So we can talk about that in a little more detail, but we can illustrate it by virtue of an example. So again, the key notion is that no money is going to change hands up front. I don't have to pay the seller doesn't have to pay me as the buyer or the long position in a futures contract at date zero, the origination. So what it really is going to come down to is how do we figure out what the contract price needs to be where both the long and the short side of the transaction are satisfied with that. So let's take a look at a related issue in terms of what we would do if we want to get out of a contract early. And that's what's going to be referred to as unwinding a obligation that we've made before the end of the contract, before the maturity of the contract. So let's just take a simple numerical example and we'll see the issues. And we'll also see how a contract that starts with a value of zero ends up having a positive or a negative value over time. And so here's the idea. Let's start, assume we're in April and that we agree to be long in a futures contract for a commodity. Let's just call it X, could be wheat or it could be a physical asset like gold, 100 units of it, and the contract is matures in 6 months' time in October, and we lock in a price of $3 per unit of commodity X. But now here's the wrinkle: we don't actually get to October. We've seen what happens if we go all the way to expiration, but in this case, we're going to assume that we want out after only 3 months. So we're going to want to unwind our position or effectively get out of our position 3 months early. So in July rather than all the way to October. But in the meantime, the new price in July for an October delivery is gone up to 345. All right, and what we'll see is that we will have actually made $45 off that transaction if we unwind our position in July, because the price has risen and we're the long position. But let's see that visually, so we can make sure we understand. So again, our original contract, and this is the key to understand, is that we had no value in the contract. So one thing to recognize is that we can think of futures and forward contracts as securities, but in essence, they're not the same as owning a stock or a bond. What we have is a trade agreement, essentially. The contract represents the ability to make a trade at a later date. And so there's no value to that initially because the future hasn't happened yet. But so we're obligated to pay, in this original deal, $3 a share for unit X come October, 6 months from now. But now what happens is that, let's say by July, the price of the futures contract, so the new price in July for a contract that matures in October, maybe there's been a drought and this is an agricultural entity, like wheat, and it's gone up in price to 345. So the way we can think of unwinding, we want out. Our contract calls for us to stay involved until October, but now in July, we want out. And so the way we can think about being out, so this is us again, or this is our position. So we could take an offsetting short position. So we are, come July, we are obligated in 3 months' time to be the buyer of commodity X at $3 a share. So the way we can offset that commitment is to essentially take an offsetting short position in commodity X for October, come July, but now our sales price is going to be 345. So now we have effectively two positions in July. Our original contract from last April, which calls for us to buy commodity X for $3, and now we have a new contract to sell that unit of X right back, but we sell it for 345. So what happens is that the value of our contract net has gone up by $45. So we are buying at 3, but we're selling at 345. And so what we have is now value in the original contract of 45. So that's the way an unwind is actually going to happen, is we would just call back the exchange. They would look at the prices. We wouldn't literally create a new contract to offset our original one, but we would just sort of sell back the original position, but we'd be selling it back at $45 more than we would have been obligated to buy it come October. And so we're going to get that $45 upfront in July when we unwind the position. But one of the critical things to recognize here is that we originally had a deal with a value of 0. But effectively what's happened now as prices rise, so we get into the original deal in April, we lock in our October purchase price for commodity X of $3. But now that price, although that's going to stay locked in until October, the market price for commodity X is changing all the time. And by July, the price has gone up to 345. So if we want to think about this very simply, we were the long position, and after we locked in our initial purchase price in the contract of $3, prices subsequently went up in the market. So as the long position, we're going to benefit from rising prices, which is exactly what happened. So the contract to pay 3 for commodity X in October, by July, it was worth nothing in April, but by July, now that market prices have gone up, the value of our position has risen by $45, or the 45 cents contract price times 100 shares. So that's how futures contracts start off with no value, but they become valuable in the future. So then let's turn our attention to the real issue here, which is how can we set the futures contract price? How do we establish what that value of F should be so that the value of the contract at origination will be zero? So what we're really looking at is the spot price versus the futures price. So again, the difference is those are two prices that are set today. The difference is when we actually do the transaction. The spot price, as we've seen throughout the course, is the price that we would set today for a transaction that gets completed immediately or as quickly as we can. The futures price is set today, but for a transaction that we purposely defer making to a later date. And so let's think about the relationship between those two prices, and we'll use an example to kind of work our way into it. I think that'll be easier for us to understand. So let's say that we've agreed to deliver 5,000 units of some commodity, let's say corn, to our counterparty at a later date. And so we've agreed to be the long position in a futures contract over, let's just say, the next 3 months. So what price should we charge? How should we think about setting the futures contract price? And let me give you one way to think about it, and this is a good way conceptually to understand what's going on. We've now obligated ourselves to, I'm sorry, we're the short position, so we're delivering, so we're the short position. Let me make sure I didn't misstate that earlier. So what should we charge? What should we lock in today as the price to sell corn 3 months from now, 5,000 units of it? And the way to think about it is as follows. We want to know that we'll have 5,000 units of corn 3 months from now to actually sell to satisfy the obligation of our futures position. So one way to ensure that we'll have corn in 3 months' time is to buy it today at whatever the current cash or spot price is, and then just store the corn into the future, so that come 3 months from now, we will already have the corn that we can deliver. So then the cost of that would be whatever it is we had to pay for the corn initially, plus all of the storage costs associated with effectively moving the corn forward in time between now and 3 months from now. So let's think about what the elements of those storage costs would be. There are 3. Let me see if I can highlight them in the text here. The first would be, there could be physical storage costs. As you imagine in this example in particular, if I buy the corn, 5,000 bushels of it, I would actually have to put it in a warehouse or a silo to store it. So there would be physical inventory costs. The other cost is a little more subtle, but we can appreciate this also. I'm tying up my financial capital in the process of buying the corn and holding it for 3 months. So there's going to be a financial cost associated with the storage as well. It's not just about physically storing the corn, but it's about either the opportunity cost on my own money, or let's say I borrow the money to buy the corn. So the interest expense on the borrowing is also got to be covered in terms of what I treat as storage costs. And then finally, and this is really quite subtle for some commodities like corn, but there may be, by owning the asset that I'm storing, I may actually receive cash flows. So obviously that's not going to happen with corn. But if the asset in question is a share of stock or a bond, then by owning the stock or bond over the next 3 months, I'm going to receive a cash payment, a dividend or a coupon interest payment. So I can reduce the storage cost by any cash flow that I receive. So the three components of storage then, so the futures contract that I'm going to charge, let's put it that way, has to cover what would be the initial purchase price of the asset, plus all of the costs associated with moving that asset forward in time. And there could be three dimensions to that storage cost. There could be a physical storage cost. There's a financial cost in terms of tying up my financial capital in this transaction. And I could receive cash flow labeled here as a dividend um, as a benefit by owning the asset, and that would be a deduction. So this is sometimes referred to as the cost of carry model, because what we're effectively doing is making the argument that what I need to receive is as a futures contract price is the spot price plus all of the cost of carrying it forward. Now, as we'll see, some assets will have a physical storage cost, like physical, agricultural commodities like corn or wheat. Financial securities don't have a physical storage cost. But then financial securities also have cash flows typically, whereas physical don't. Virtually always we'll see in our cost of carry calculations, we have to take the interest cost into account for tying up our capital. So we can think of that as borrowing money at that rate, or we can think of it as an opportunity cost for using our own money to invest in, say, the corn in order to store it. So then we can do this in, the easiest way to think about this is in, discrete terms like I have it here. You'll often see it in practice in continuous terms as well, but it's the same argument that the futures price is the spot price plus the cost of carrying the asset forward in time. So what we're going to see then is that there are two relationships between the two prices that are set today, the spot price, which would be for an immediate transaction, and the futures contract price, which is for a deferred or future transaction. The futures price can either be above or below the spot price. A market where futures prices are above the spot price is called a market that's in contango. And to this day, I honestly have no idea what that word means. There's a guy named John Hicks, a famous economist in the 1930s, who came up with that. A backward for the S&P 500, remember, a backwardated market, on the other hand, would be one where the futures price is set below the spot price. So if we take a look at the data for the S&P 500, remember the spot price, if we just use the midpoint of the bid-ask spread that's quoted here, is about 38.28. But notice each subsequent futures price, and all of these numbers were set on the same day in January, a few weeks ago, but they refer to buying the S&P 500 index at different points in time. So the spot price is a price we set today for immediate delivery. The March contract is we'll set it today for delivery in March rather than January, and so on. Notice that this is a backwardated market. And the reason that happens is that there's no physical storage cost for stock. And the interest rate here, we know risk-free rates are virtually zero. Dividend yields are low too, but they're not lower than the interest rate right now. Dividend yields on the S&P are in the range of about 1.4, 1.5%, whereas we know interest rates are hovering in the range of about zero. So this is a backwardated market because the dividend yield is above interest rates at the current time, and it's been that way for a fair bit of time now. So we're going to go through a couple of really good case problems in the class session that I'll save for our discussion in class. One is going to illustrate how leverage gets embedded into futures contracts. And that'll be an important discussion for the idea of thinking about investors who want to use derivatives for their leveraging properties. But we're also going to talk about the concept of stock index arbitrage. And we'll go through in more detail what exactly arbitrage represents. But just to give you a sense of the issue, to set it up, what we're going to see is that this cost of carry model, when we apply it to stock, is going to be very simple. So what this is going to give us is the theoretical value of the contract. So let's call that the theoretical F. And what we're going to see is that's just going to be equal to, for the, say, the S&P 500, it would be the current value of the index plus the cost of carry. But again, the cost of carry is only going to involve the opportunity cost or the borrowing cost, which will represent as the risk-free rate, and the dividend yield. And so that second term is just the cost of carry. There's no physical storage for carrying stock forward in time. It's a hypothetical asset in this case. And so what we mean by arbitrage is really going to come down to a comparison of the theoretical value of F versus the actual value of the contract. So what we're going to do is something very similar to what we did when we were looking at valuing, doing fundamental analysis on stock. If you remember, we used our discounted cash flow model to come up with what conceptually the stock was worth, which we compared it to what the price of the stock actually was. And if there was a difference, we would take a position. We would always buy at the lower price or sell at the higher price relative to value. Well, arbitrage, as we'll see, is going to be effectively the same scheme. So this model now, think of this as simple as it looks, as being the forward market equivalent of the dividend or the cash flow, the discounted cash flow model for valuing a security, valuing a stock, say. That tells us what the contract price should be. We can then compare it to what it actually is, what the price actually is. And if there's a difference, we can take advantage of that. So I won't go through this in detail now. We'll take a look. There's a good, I think, case problem that we'll take a look at in class to go through this in more detail. But here's an example of how Bloomberg takes a look at just using exactly the same mechanics we've just talked about, and looks at the so-called, compares the actual futures price to the fair market value. And this just gives you some of the details. We can talk more about that later. But to summarize this part of the discussion, these end up being very efficient markets. So here are fair values. So here's the spot price for each index throughout the world. So you can see the Dow Jones, the S&P. The S&P E-mini just means that those theoretical value of the asset and the price are the same.